Hey guys, welcome back to the Retail Compass. Now, with all the headlines and volatility the past week, a lot of people are talking about a possible correction. But what if I told you that this is exactly what institutions are hoping for right now and what we retails should capitalize on? I know I said last week that yes, this is a dip that we should buy, but not just yet, as the demand and supply dynamics till end October is not that favorable, and the Trump tariff tweet at first was about to tilt the balance to the downside. And indeed, we saw that even when Trump walked back his tariffs almost immediately, and that we had multiple good news on the AI front, we didn't really get that V-shaped recovery, and we only recovered half the losses from that one-day Friday sell-off. And that's precisely due to the fact, as how I flagged, that institutions are already relatively long stocks. However, several pieces of key news last week was actually important enough to keep the market afloat till end October. And that's where it gets interesting. Once we get to end October, everything will line up to point to a setup that could turn into a powerful year-end rally once we go into November. And I will tell you exactly what's about to hit the market in the next few weeks, so you'll see why every dip from here can be bought. Now, before we dive in, if you are serious about understanding markets the way institutions do and not the way headlines explain them, because let's be honest, those are usually totally meaningless, then hit subscribe. It's completely free, I don't spam, and you might just pick up one or two ideas that helps you in some key investment or trading decisions, which can go a long way for your personal finances. And of course, if you ever feel it's not worth it, which I doubt, you can subscribe anytime. Okay, now let's break down what's really happening right now. Currently, market is quite fragile for a few reasons: institutional and quant positioning, lack of corporate buybacks, and increasing volatility. Now check out my other video here if you want to find out why exactly these are the case. But in terms of timing, we are right at the peak of corporate blackout window. And this means that companies can't buy back their own stock. It's roughly 2 weeks before quarter end and lasts until they release results. So right now, one of the biggest consistent buyers of US stocks is temporarily offline. But here's where it turns bullish. This year, US buyback authorizations have exploded to 1.29 trillion. It's the fastest ever pace on record. And once these companies exit blackout in late October, all that pent-up authorization converts into real buying demand. Now we are talking roughly 5.3 billion in daily buybacks that will start hitting the markets once that window opens at the end of October. So think of it like this, right? The market has been holding its breath for weeks, and suddenly one of its biggest oxygen tanks come back online. What do you think will happen? Now, that's not speculation, it's just math. So history has shown that while usually October is very volatile, November, December are the strongest months for buybacks and for stock performance. Well, the data across a full century of market history can't lie. And from years of history, we can see that the S&P and Nasdaq often bottomed around October 26th to 27th. And from there, the so-called Halloween to year-end rally takes off. So this seasonality effect over so many years is not just pure coincidence. It's due to the year-end structural demand kicking in. Now, if you're not already convinced, let's add to what's happening politically. Mid-November marks the stretch run into the US midterm elections. And like it or not, Donald Trump is going to do whatever he can to retain a strong majority in the midterms. Why? He really does not want to risk being impeached for a third time. And that means he has zero incentive to tighten financial conditions or the spook markets right now, which is probably why he reversed the tariff rhetoric so fast. So, because crashing markets simply don't win votes, right? So he wants the economy to stay strong, confidence to be high, investors to feel rich going into that ballot. So one thing that we've learned, after not fighting the Fed in 2020 is not fighting Trump. Even though, to be honest, that's a much harder thing to do because sometimes Trump doesn't even know what he himself is doing. But jokes aside, okay, speaking of liquidity, there's a third quiet driver that I think people are just not watching closely enough. Last week, Jerome Powell from the Fed signaled that he may slow or end quantitative tightening faster than expected. So quantitative tightening, or QT, is basically the process of shrinking the Fed's balance sheet, and this pulls liquidity out of the system, by reducing bank reserves, forcing private investors to absorb more of the treasury supply. Now, if QT is going to be ending, what does that mean? That just means liquidity, money, is going to come into the system. That's a subtle but very, very powerful shift. The Fed is moving from draining liquidity slowly to at least stabilizing it and possibly increasing it. Now you put all of this together, right? Come November, what do you get? You get a setup where every single near-term dip could be met with structural buying demand. From corporations buying back shares, policy support from both Trump and the Fed, as well as resilient retail buying. So if by any chance, in the next 2 weeks, whatever headlines comes out results in more drops in the stock market, I think anything between 2 to 5% drop come late October, you can strongly consider to deploy any lump sum investments you have, as we are likely to see a next leg higher in stock markets going into year end. So that's all I wanted to share with you guys today. Again, if you want to understand what truly drives the market and what marks key turning points, feel free to subscribe so that you don't miss any important updates. Also, I'm going to post more regularly in the YouTube communities page, so please feel free to leave any questions you may have and I'll try to answer all of them. Well, until then, see you next time.